Welcome back to another video from Netpicks. Today's video is about trading with the trend. And before I get moving forward here, this free guide is about price patterns. And it's actually been pretty popular. And it's a free download you can get, trading with price patterns. And the feedback that we've gotten over here at Netpicks about this free guide has been pretty phenomenal. And the link is up here to the right, or it's in the description below. All right, so let's get back to what we're talking about, which is trading with the trend. And actually, it's a pretty simple concept, right? You take trades only in the direction of the price trend direction on the time frame that you're trading. So the trend goes up, you're only going to consider long trades. A market that is going down, only short trades. And these are trading positions that when you do take them, they should encounter less pushback of the market, as opposed to always trying to pick the top and the bottom of the market. Now, also keep in mind that markets, they don't only move up and down, but they also move sideways. And we can call that a trend, but we're going to call it a trading range. Now, the key is to know exactly how to identify the trend, which we can do with an indicator or even just reading price action in the structure. But first, we want to talk about how the markets move. And we generally look at three stages to a market. We look at a trend, a range, trend, range, trend. And you can see that smooth trending action to the upside, and you'd want to be long. At ranges, when those hit, you could also see a breakdown to the downside. That's where trends can change. So is that actually a change of trend direction where you're only going to look at short trades? Well, that depends. And I'll get to that in a minute. So price trends up, ranges, we head up again. So trading with the trend just means trading with the main direction of price. And trading with the trend would have you long, and depending on how you measure the trend, you either hold or you'd exit at the trading ranges. So how you measure it is pretty much less important than you being consistent in how you measure it. And it's really easy to determine the trend, and then when the market changes direction, override your trading plan to catch the move. And this happens a lot when the market moves in the opposite way with momentum. Moving averages. Probably the most objective way to determine the trend in Forex, futures, doesn't matter, even the stocks. And it does come with an issue that trading indicators face, and that's lag. And all lag is when the markets change direction, but the indicator is still on the prior trend. And you also have to consider the moving average settings. A short-term average would have you trading with the trend on a shorter-term basis. An example would be a 10-period SMA. That's going to react a whole lot earlier to price than a 200-period SMA. The longer-term averages, they may have you sitting through drawdown. That's when your trade's losing money, depending on your exit strategy, of course, before it changes direction. And there are other averages to consider. We've got the WMA, SMA, EMA, displaced moving averages. But if you're going to use it, when you use it, you got to also know how you're going to read it. So are you going to use the slope of the average for your direction? Do you need price to break through the moving average? Is a breakout pullback to the average something that you need? And really, there's no best way to determine the trend with averages. You just got to find what you're comfortable with, because you're not picking the top or the bottom of the market. And the moving average will also show you when there is not an uptrend or a downtrend that you can actually trade. So when price is churning around the moving average, we can consider that a range-bound market. On this chart here, using the 50 EMA closing price calculation as an example, once those closing prices are not finding momentum away from each other, well, the average closing price from one day to the next will start to show minimal difference. So this is going to allow the moving average to catch up to the price bars. And that's what gives the illusion that moving averages are providing support or resistance. And you can use the average as a non-trending market indicator as well, like you can see on this chart here. Well, what about price structure? When price moves on a chart, it leaves clues in the form of structure. If we consider that range-bound market we just looked at, price action with similar highs and lows is a range. So a trending price structure is made from price action not having similar lows and highs. This is probably the purest form of technical analysis when you're determining the trend. And we can define a trend in this manner. Price is making a series of higher highs and higher lows. That's our uptrend. Downtrend markets, prices making lower highs and lower lows. And when that structure is violated, I consider a range is beginning. This is a stock chart, and it has a mixture of 3 different trends: a sideways trend, an up, and a downtrend. And you're going to want to have some general rules on how you interpret the charts, when the trend changes, when you determine there is sideways movement. So looking at this chart here, support and resistance, remember that there's zones. And if price makes a high or a low in the same general area, I call them equal, I consider a range. If price, as in this example, makes a lower high, but a higher low, well, to me, that's still a trading range. Price breaking out can be the first sign of a change in trend, but the higher high has to be followed by a higher low. Some traders will actually wait until the higher low is confirmed by a break of that high. So we see price drops through with momentum. We have a higher low, and then we have a lower high that's put in. So now we have a defined downtrend. So price will break through highs and lows, but then you have to determine if that break is a legitimate change of trend or just price probing the areas. And that's where looking for price activity after a break of a swing high or a swing low to confirm there is a change is pretty important. Trend lines. Well, first off, how you draw them is pretty subjective. So you have to have rules to follow when you're drawing them. And the general rule is fanning trend line so the line does not cut through current price. The additional rule I use is I have to be able to capture the last swing low into a high, for example. So remember, you need at least 2 swing levels to draw a trend line. And here's a breakdown of what we see on this chart here. Number 1, this is a main trend line, and it's the line in the sand for a change in trend. The second point for this trend line is the final high before a new low. And I draw this because the first one would cut through price. At 3, we start to fan trend lines here due to the slope of the emerging trend. And I want you to keep in mind, there was no price after this when these were being drawn. So that's why this line is dotted, so you can see the difference. At 4, it's the same anchor point at the low, but we have a new higher swing low to connect to. At 5, it's the final trend line into the high. And number 6, the main trend line. So the purpose of the lines connecting the final low into the highs, that's an early warning sign for me of a trend change. It can also actually set up a trading entry with a trend type of setup that I'm not going to cover here, but it's called a 2B reversal. But the key point is a break of the trend line shows that something has changed with the rhythm of the market. And this is even more important when the break is accompanied by momentum. And before you ask, no, there's no best momentum indicator to help you judge the strength, but there are certain candlestick patterns that are pretty helpful. Now about trading with the higher trend. There are as many trends as there are time frames. A downtrend on a 1-hour chart could just be a pullback on a 4-hour chart. So why do traders look to trade with the trend of the higher time frame? Well, the logic is that the higher time frame has more power on the lower time frame. But I want you to keep in mind that a higher time frame trend can only start when the lower time frames turn direction. So if you understand that, there are 2 main trend determination tools, along with the ones that I've already talked about, that we can use on the higher time frame. The MACD. The first one I want to talk about uses the setting by Joe DiNapoli of 8, 17, and 9. And right here is the daily chart with the weekly MACD at the bottom. So the general rule is to trade in the direction of the cross of the MACD signal line using your trading strategy. The histogram is also something you want to watch for. In this example, the rising histogram is showing downside momentum is fading. And traders can use the rising histogram along with price to start trading in the emerging trend direction on the lower time frame. And I actually find that trading the breakout with this method is a pretty decent approach. So in our chart example, you can see the histogram is rising along with the higher low being put in, which points to further trending upside. And that's just one of the many MACD techniques that you can use when you're trading. Displaced moving averages. This one is using moving averages, but with a little twist. We also use displaced moving averages in the indicator known as the alligator indicator, and we just simply displace forward the plotting of the average. So in our example here, we're going to use the 6-period setting of the high and low price displaced by 4 periods. And this is a daily chart example, and either the weekly or the monthly chart, you can use those for trend direction. When price closes below or above the averages, you will trade that direction on the lower time frame. So what do you do when price enters the space between the two displaced averages? That's going to depend on your trading plan. You can also use price structure in combination with this method. So as an example of that, the middle of this chart shows a break to the downside and then a move back to the upside. But on a daily chart, you would notice that we actually made a double bottom was put in. And that would alert you to a potential trend reversal before the indicator does. We covered a lot, so let's kind of wrap this up. Basically, trading with a trend is trading in the direction of the main price. And there's different ways you can determine trend direction, and you can also determine it either in a conservative way or an aggressive approach. As an example, waiting for the MACD cross is conservative due to the confirmation aspect of it. Watching the histogram start to rise along with price action is a little bit more aggressive. The key is to find one that fits your trading style. And looking for the best indicator, it's a waste of time. That time is better served adjusting and perfecting your trading rules. Using volume and price to determine trend direction is also pretty viable. And this video here about the KLINGER volume oscillator is actually a really good place to start. All right, thanks for watching. If you have any questions, just pop them in the comments.